instead of paying principal and interest all entire amount at the end of the note, I can spread the total principal plus interest equally throughout the period. So how do we calculate the installment payments every year? So let's see the example of the textbook. On January 1st, 2019, Foghawk borrows $60,000 from a bank to purchase equipment. It signs an 8% installment note requiring 3 annual payments of principal plus interest. So here, the company borrows $60,000 on January 1st, 2019, and he needs to determine how much equal payment should he make every year for the coming 3 years in order to repay principal plus interest for these 3 years to the lender. Well, $60,000 represents the amount of money today, so it's the present value of all these future payments. So we can write a formula as this. X amounts, the first X, divided by 1 plus interest rate, power of 1, plus the second X divided by 1 plus interest rate, power of the second payment of X will be discounting for 2 years, so power of 2, plus the third payment X divided by 1 plus interest rate, power of 3. Okay, when we try to figure out the present value of these future payments, we use division. So these 3 payments together should be equal to present value, the amount of money I received today. And we can rewrite this formula as X pulling out. The first element here is 1 over 1 plus interest rate, power of 1. And the second element here, X being pulled out, the second element becomes 1 plus interest rate, power of 2. And the third element, X being pulled out, so the remaining is 1 over 1 plus interest rate, power of 3. So all these calculations in the bracket is called discounting factor. And where can I find this discounting factor? Since I have a series of payments, we call them annuities. And in your textbook, when you scroll down to present value of annuity, you can find a discounting factor. Right. So this example on the textbook says 8% for 3 years. So we go to 8% for 3 years, 1, 2, 3. The third row, 2.5771 is the discounting factor. So X multiplied by 2.5771. So X multiplied by the discounting factor should equal to my present value. As a result, X is equal to 60,000 divided by discounting factor 2.5771. x equals to 23,280. If we round it to dollar, $282. That's why on your tax bill you see the payment every year is $23,282. Well, how do we make journal entries? I would like to use amortization table. So this is an amortization table. It has the column of cash payment every period, interest accrued every period. The difference between cash and interest will be the amount of principal being paid out of this note. After you make the payment, what's your remaining debt to the lender? So for example, here on January 1st, 2019, when they borrowed money of $60,000, they didn't have any cash payment on January 1st, so no interest is accrued because that's the beginning of the note. Since no cash, no interest, there won't be a difference between the two columns. The beginning debt you owe to the lender on the day of January 1st, 2019 is $60,000. And then 1 year later, you are going to make payment of what we calculated here, $23,282. From January 1st to December 31st, you accumulated 1 year of interest. And in our example, interest rate is 8%. So 8% from your debt that you haven't paid out is multiplied by your previous outstanding balance on January 1st. So that is $4,800. So your interest expense is $4,800. So out of your cash payment, some goes to your interest expense. The remaining is $18,482. So the div column for December 31st, 2019 will be $18,482. So out of this cash payment, you not only paid off interest, but also some portion of the principal, notes payable. So the $60,000 is no longer so high. You have paid off some of your debt. Therefore, your outstanding balance of your debt should be reduced by the principal being paid off. So the new balance for your notes payable becomes $41,518. Okay, and then the next year, 2020, you make the same payment again. And out of this $23,282 of payment, how much is interest? Well, we will calculate from following what we did last year. We used previous balance multiplied by interest rate. So now we are in 2020. So previous balance was $41,518 with 8% of interest rate. So the interest for the past 2020 is $3,321. If we round to dollar, as a result, out of this $23,282 of payment, $3,321 goes to interest. The remaining pays off the principal. So div column is $19,961. So the new outstanding balance is from previous $41,518 subtracted by the portion you paid off in 2020. The remaining debt to the lender is $21,557. And you can continue this table until the end of the note, but I will pause here. The reason we use this, we put calculation into amortization table is to help me journalize the transaction. So let's journalize the issuance of the note. January 1st, 2019. I will debit cash because I received money from the lender of $60,000, and I will credit a liability called notes payable for $60,000. And the second transaction is the payment of $23,282. Since I am paying, I credit cash for $23,282, and of this payment, $4,800 is interest, and we call it interest expense. And part of $23,282, $18,482 is the principal. And my principal is accounted in notes payable. So here my principal is written off as notes payable by $18,482. Try one more time. For the next at the end of the third year, we make another payment of the same amount. How do we journalize? Following our journal entry for 2020, again, I have cash payment for $23,282. Of this payment, some goes to interest. And the interest according to our amortization table is $3,321. And the remaining out of the payment, $23,282, is the principal. And principal again is accounted in notes payable account. So principal is reduced by the amortization table calculated as $19,961. That's why the journal entries are like this way. And you can observe from our amortization table, as time goes by, interest will be decreasing and the principal portion will be increasing. So this applies to any kind of installment notes or mortgages. So the same amount of payment every period. Early stage of the note, most of your payment goes to your interest, and the interest will gradually decrease. And then the principal payment, the payment that covers the principal component, will gradually increase. The textbook put the amortization table this way, but I prefer you to follow my amortization table columns, because in your next finance course, they will use these columns to calculate the present value of the debt instrument. Okay, so that's the end of chapter 14.